Hey everybody, it's Professor Jonathan Barth, Associate Professor of History at Arizona State University. Thanks for tuning in. We've got with us a distinguished guest, Dr. Tyler Watts, and we're going to talk about stablecoins today. So it should be a good discussion. Dr. Tyler Watts is a professor of economics at the Ferris State University College of Business in Michigan. He earned his PhD in economics in 2010 at George Mason University. Grew up in Colorado Springs. He's published with the Quarterly Journal of Austrian Economics and other academic journals in his field, and recently published a two-volume book, Excelonomics, Teaching Economics with Excel. And Dr. Watts has been doing some work on stablecoins. He's done a lot of other things as well, but he actually reached out to me a few months ago, and he had watched some of my history of money lectures. He does a lot of work on free banking in the United States. And so we were conversing about that. And then he linked me to some recent work he's done on stable coins. And just thought it would be great to have him on. I haven't done a video on stable coins, in part because I'm still learning about it. So I think this should be a good discussion. Thanks for joining us.
Good to be with you.
So we'll just get right to it. What are stable coins? What's a good, basic working definition? If you were in like a college classroom, entry level, how would you describe it?
Stable coins are a form of cryptocurrency that is the stable part is because its value is supposed to be pegged or tied to another currency. So we'll talk about US dollar stable coins. They're supposed to stay at a value of $1, and they might fluctuate within very narrow bounds. So it's basically a form of paying people dollars, or we could say spending dollars, that's in a cryptocurrency like environment, like a blockchain. And I'll tell you, I was kind of skeptical. I've been into monetary history, and by the way, you've got fantastic monetary history videos on YouTube. That's how I found you, and I was looking for free banking material, and I think you and I are some of the only people who are talking about American free banking in YouTube. So it was pretty cool to meet you that way. But where was I going with that? Oh, I've been kind of skeptical of things like Bitcoin, and we can talk about this because when you talk about kind of classical monetary theory, what is money? It's a means of exchange, and I just don't see a lot of people using Bitcoin for exchange. I see a lot of people speculating and maybe hoarding it, or calling it a quote investment. And to me, that breaks down that demonstrates that that's not really a money, because I don't invest in money, I spend money. And if I invest, I use the money in my bank account or whatever to go and buy stocks or bonds or something that's going to earn me a return. So I've been skeptical. I've kind of been on that side of the fence as to Bitcoin, raised eyebrows at best. Some days, I look at that and say it's probably a scam. I don't know if you want to get into that so much, but I want to give some background and kind of full disclosure, because there might be some Bitcoin fans out there, and if that's fine, it doesn't bother me personally. That's my prior on it. So I never got into crypto a whole lot. I've taught money in banking, and when I teach money in banking, I talk about what we have. We have fractional reserve, commercial deposit banks. We have the Fed. I do a lot of U.S. history because I think it's important to understand where we've been, to understand how we got to where we are. And then students will ask me about crypto, and I'll say, well, it's not really money because it doesn't meet the means of exchange function. Bitcoin's the most popular one, of course. I think Bitcoin's the only one that deserves to be taken seriously because it's had so much staying power. Most of the other ones have kind of fallen by the wayside.
If I may, Ethereum, I think probably has some
Yeah,
good
and
staying power.
Ethereum is interesting because it's more of a blockchain package.
Yeah.
It's broader than just a currency component. So I've been kind of dismissive of cryptocurrency, but when this Genius Act was being debated and proposed earlier this year, I got a little more interested in it, and I realized, well, there's a parallel here between this idea of stable coins and what we had in free banking. And I wrote an article, I believe I shared that with you, that prompted this discussion, that kind of draws out some of the connections. I'm a big fan of free banking, and I see some connections, maybe tenuous, but I think they're there between stable coins and free banking. And so that caught my interest, and that's why I've started learning more about stable coins. Now I'm actually teaching a senior seminar kind of class here on cryptocurrency. So I'm diving into everything,
Oh,
going Ethereum, tokens, stablecoin, everything. So I'm bringing myself up to speed. I might be kind of 5 or 10 years late on this whole thing, but so I'm interested in stablecoins, and I'm intrigued by them because of that connection to what we had in the free banking era. In free banking, banks were free, well, with a lot of constraints in the US experience, but to somewhat, at least, let's say, free to issue their own currency. And with stable coins today, that's institutions that don't have to be banks, actually.
yeah,
This is part of the consternation with it. We've got non-bank entities issuing what effectively is currency. I like to call it
right.
digital banknotes or digital
Yeah.
currency. It's a means, it's a way to give another person an asset that is one-to-one with the US dollar. And if that tie is reliable, it's just almost as good. Like
Mhm.
almost as good means good enough. And it's going to be a, let's say, economical way to transfer money between people and kind of maybe fill in some gaps, or at least make the payments aspect of the banking system way more efficient than it is. And a lot of people don't realize these inefficiencies because they're kind of hidden. A lot of the costs we pay um, with commercial bank in the central bank systems that we have, a lot of the costs are just kind of hidden. They're behind the scenes. They're kind of built in to the products we use. So a lot of people don't see the rationale for stable coins, and I think there's a huge amount of skepticism because they think, oh no, we have unregulated entities issuing money. This was a disaster last time it was tried. There are regulations. We can talk about that from both the government and the marketplace. B, it wasn't a disaster last time it was tried. It actually worked really well, even though the regulatory environment was terribly, let's say, I don't know, constraining of what we might, of kind of the free market that we might like to have. So I don't know. I've probably opened about 5 different topics,
Yeah,
roads
no.
we could go down there.
Yeah, no, there's a lot to say. I would like to talk a little bit more about Bitcoin and crypto. Let's put that on the back burner because that's very
Okay.
interesting, and I think our audience would like to hear more about that. No, yes, and if I understand correctly, the issuer of stable coins like Tether, for example, I believe is the largest issuer. Is that correct, or do you know?
Yeah, I believe that's the US dollar coin.
Yeah, it's pegged to the dollar, and I
That's
looked it
there's
up.
a Yeah, the different entities have different terms, and I believe the Tether one is called USDC.
Okay,
So
I
it's very
looked.
evident in its name. Like this is
Yeah,
uh, meant to be equivalent with US dollars. And
that's
to the
right,
extent
and
that that issuer is trusted, people will accept them and on par with US dollars. In all the research I've done, I found chart. I think I might have it somewhere still on my screen. US dollar coin. Yeah, that's the Tether one. And it's actually, I'm looking at a chart here from September 22 to September 23, and it never dropped more than like 0.1% below $1. And that was very briefly. And it actually rose above $1.
uh, that's pretty good.
But there's a very, very narrow
Yeah,
band. It's
yeah.
effectively equal with the dollar in a very reliable fashion. Now, there's been other stable coins that failed, that the value fell significantly below maybe 2 or 3 cents, and that's if you're
Oh,
dealing with
okay.
large amounts of money. If you go 2 or 3%
Yeah,
below par, you're taking some big losses.
right. And
Uh,
Tether,
we we
I looked
I'm
it
sorry.
up.
Go ahead.
I looked it up before our discussion. Tether has a market cap of $167 billion, which is nuts. I
Yeah.
mean, it's
And
huge.
now with Genius Act passing, going into law this summer, I think it's going to it's growing pretty rapidly, as we speak.
Although there are some questions, and we'll talk about the Genius Act. For our audience. That's the act signed into law by President Trump in July, regulating stable coins. We'll get to that, but um, Tether is a foreign issuer. I think they're located in the Virgin Islands, the British Virgin Islands, so that may complicate things a bit. But um, the so the issuer, I like what you say about the free banking system and the parallels to that. Under free banking, banks were permitted to issue banknotes, and those banknotes were redeemable on demand at the bank. And if they were part of a clearinghouse, I think New York had something like this, the other banks would honor these notes as well, but you could redeem them at par for whatever the amount was. Everybody knows that cash is going out. Today it's all about digital bank dollars, and looked it up before this discussion, but digital bank dollars today add up to just over $18.5 trillion, whereas the physical cash in circulation is only 2.5 trillion. That's
And
a that's
something like half of that physical cash is outside of the United States as
Yeah,
well.
exactly. So we're talking about more and more people moving to digital bank dollars. Only 17% of all in-person retail transactions now are in cash. I think that comes from the Federal Reserve, that stat. So digital bank dollars are liabilities on private entities, commercial banks, and they promise to redeem a digital bank dollar at par into US currency. So my question is, how do stablecoins differ from that? Is this just a new, it sounds like it's just very comparable to like a digital bank dollar. Like, what
Right. So
distinguishes a stablecoin from
so
this?
when you say digital bank dollar, you're talking just about using electronically transferring dollars through the commercial banking system.
Through, yes, electronic ACH transfers,
Yep,
debit card,
ACH,
credit
debit
card,
cards,
you know,
and we in the banking parlance that would be called deposits, right?
right.
Demand deposits, roughly equivalent to checking accounts. And when you swipe your debit card, as I tell my students in money and banking, like economically speaking, that's the same thing as writing a check. It's
Mhm.
just a much faster and more efficient system because the check doesn't have to be, well, today the checks are scanned. Back in the old days, there's a great scene from the movie Catch Me If You Can. Frank Abagnale was a check forger. And so he knew that checks had to be mailed to the clearinghouse or the Fed. And in the time it took for them to mail it and process it for payment and transfer the reserves from the issuing bank to the recipient bank, he could get away with kiting thousands and thousands of dollars and be well on his way to the next city. So, but a debit card is no different kind of functionally than writing a check. It's just faster and more efficient. Well, that's so we can pay money electronically. In other words, we can have the order to transfer money from my bank account to your bank account. Right? I'm going into Walmart to buy my groceries. When I swipe my debit card at the end, all that's happening is the ACH network is getting an order to transfer that money from my bank account over to Walmart's bank account the next time they transfer a batch of or process a batch of payments. And with debit cards, that can be near instant, but a lot of times it'll settle maybe at the end of that day or sometimes the next day. And that's one aspect of stable coins that we'll get to. They're even more efficient than that. So digital bank, I'm trying to remember the term you used, digital.
Digital bank dollars. I'm sure there's
Yeah,
a
digital bank
yeah.
dollars, let's say electronic payment
Hmm.
using checking accounts.
Hmm.
Banks issue checking accounts. I don't know if we need to get into kind of fractional reserve banking theory there. Let's assume people understand that. So the difference between stable coins and that is that, well, stable coins are let's say it's a parallel system. It does the exact same function, transferring money from me to you.
Hmm.
Um, but because it's not beholden to the way banks operate, it's
Yeah.
not beholden to the bank clearinghouse, it's not beholden to the regulations that banks have to operate under. It can be actually, and because it's crypto, it utilizes a blockchain,
Mhm.
decentralized network recording, let's say titles or claims to the coins, the stable coins. It can just operate more efficiently. Um, you mentioned the ACH, and I mentioned this in my article. I'm actually going to look over here for the exact number I cited. I think the typical fee, they call them interchange fees for debit card transactions. Well, it actually depends a lot on the
It's like
volume.
25 cents, I think, or yeah, it
Yeah,
depends on the
for
volume.
most of your small time
Mhm.
purchases, there's a regulation that caps it. I think it's actually like 10 or 20 cents, if I remember right.
Yeah.
And they can go up from there. And then you mentioned credit cards. Credit cards usually
Oh,
charge a
yeah.
swipe fee of like 2.5 or 3%.
Yeah. Yeah.
Stable coins, they don't really have a swipe fee because there's
No.
nothing to swipe. And because that blockchain technology is so efficient,
Mhm.
it can be an instantaneous transfer with minimal to no fees. So there's some advantages that stable coins have being outside of the banking commercial bank system and the commercial bank payment slash clearing networks.
Absolutely. And that's one of the things that really attracts me to stable coins is that we have it's really it actually is like digital cash. And in the sense that it is out entirely outside of the banking system. You're still
Right. And
utilizing,
let me,
yeah,
if I can mention really quick before I lose this, I don't want to cut you off, but an important thing I should mention is that the users of the stablecoin do not need to have a bank account. That's one of the big
right.
draws. For me to write you a check, you're going to deposit it in your bank account. You need a bank account. For your business to accept debit card payments, you have to have a bank account tied to that clearinghouse. With
Yes.
stablecoins, all you need is a stablecoin wallet, and
Right.
that does not need to be tied to a bank account.
No.
You need is a smartphone.
Yeah.
And once I have an app with a stablecoin broker or issuer, you and I can send stablecoins to each other.
Yeah.
Now, if I want to convert them into actual physical dollar bills, Federal Reserve note currency, I would have to transfer them to my bank account, and then I could go and withdraw them from an ATM. But in a cashless world, we could do probably all or nearly all of our transactions with stablecoins on an app, and we never need to access that bank.
Yeah.
And of course, there's other benefits to having bank accounts, but in terms of the payment processing, stablecoins can bypass what banks do and make it just more efficient and fast. The benefits of stablecoin: don't need a bank account, much much less expensive to transfer titles to stablecoin on the blockchain network than to go through the ACH or whatever the Fed also does clearing for banks. And they're also the transfers are pretty much instantaneous, no waiting for your funds. So
Right.
that's kind of the let's say the case for stablecoins or the benefits of stablecoins.
Yes. And yeah, with the ubiquity of debit cards and credit cards and these fees that are charged, especially for the credit cards, I mean, 3% per transaction. In a way, it functions almost like a private sales tax that
Yeah.
on every transaction that's transferred to this like private financial system. It's and I don't think people don't view it that way, but that's essentially what it is. And as
Well, let's say it's a transactions cost. It's a transaction cost,
it is, but when
if we can find a way to do the transaction without paying the transaction cost, that's an obvious win. I'll
yeah,
give you an example. I didn't mention this in my article, but I have a few different little side businesses, and one of the suppliers I used to buy from locally, I would buy, maybe $300-400 worth of materials. Sometimes I don't know, $600 worth of materials from them sometimes. And I would go to pay, and I have a credit card for my business account, and I present my credit card, and they'd say, "Oh, we're going to charge you 3% payment processing fee for that because they don't want to eat it."
no,
And I say, "Oh, really?" So I put that back in my wallet and get my business checkbook out, and
yeah,
I'm here right. And this is, recently, I'm here writing a check in the age of digital, electronic banking and digital money. But I'm still here writing a check because 3% of $600 purchase that I'm making routinely, that adds up.
yeah.
And I'm thinking,
I
boy, if we just had stable coins, none of this would be necessary. We don't even have to swipe the card.
Yeah, I really appreciate it when businesses, it's usually small businesses, give you a little discount if you pay in cash. It makes sense.
And they
Uh,
did. They gave me, and they trusted my check, which I thought was nice. And they didn't give me, didn't tack the payment processing fee on there.
But you know, if the federal government passed a national sales tax of 3% on all transactions, you know, Americans for good reason would be like up in arms about that.
Absolutely.
But
Yeah.
then we just accept, you know, these credit card processing fees as normal. And you're right, it is it's a, you know, it's a transaction cost, etc. But it would be, I mean, that's what's so great about the stable coins, and that's why for a long time I've said told people if you can pay in cash if you can. But a lot of times that the convenience of that digital payment is really nice and or necessary, and so it's good to have an option like stable coins. And that leads me to my next question. So this Genius Act, can you know, I don't know if you want to sum it up or you know, just the basic idea behind it, and then what are your thoughts on it?
So yeah, I'm not. I don't want to portray myself as some kind of expert on this. Yeah, I've just done some basic research on it, but it's a law that kind of institutionalizes stablecoin and provides a pretty stable, pretty let's say clear and stable regulatory framework. So a lot of kind of crypto and stablecoin fans are like the Genius Act because okay, we have clear-cut regulations and everything. It's all legal, it's all clear. So the main aspect of the regulation is that any entity that's approved to issue stable coins through various government channels, and they can be federal, so banks can do it, and they're going to be the stable coin regulations enforced by the bank regulatory mechanism, which is it's a very multifaceted thing in the US because it depends on whether you're a national chartered bank, and that's the comptroller of the currency, or a state chartered bank. So that's going to be done by the Fed and the FDIC. There are a lot of different layers here. So banks can do it, but non-bank entities can also do it. They have to, they either register through their state or through, can't remember exactly which federal regulator is going to handle the non-bank ones.
Right.
So it says, here's who can do it. Here's who's going to regulate you. The main regulations are what we would call the quote backing. So stable coins, the worry and the risk is that, well, if you issue stable coins and you don't have the assets, the dollar assets behind them, and people want to be paid the dollars, you know, basically want to cash in the stable coins and get the dollars. If the issuer doesn't have assets, well, let's say money or other assets that they could sell to come up with the money, then there's a risk of the classic run on the bank type phenomenon, and the issuer goes bust and people panic and people start to pull out all their money out of the stable coins and the whole system collapses and on and on. So there's that. And I think that's very overblown regardless of the regulatory structure, just because of the nature of intermediation. But let's for the sake of argument, let's give that to the worry warts and say, okay, so the regulation is going to, and this is what the Genius Act did, probably the most important thing is it has to be 100% backed. Every stable coin has to be 100% backed by a very liquid, either dollars themselves. So it can be current, it could actually be currency. You could have a briefcase full of $100 bills in your vault, or bank deposits at a commercial bank, which of course are FDIC insured, you know, to the large extent, FDIC insured. And
Treasury bills too, but short dated,
and then
I
of
think.
course, short term, yeah, 93-day or less maturity treasury bills.
Yeah.
Well,
Yeah.
actually, all treasury bonds, I just learned this, it doesn't have to be short term bonds. It could be
Oh.
long term bonds as long as they're under 93 days to maturity.
Oh, okay, okay.
So it could
Gotcha.
be 10-year treasuries that are almost
Gotcha,
mature.
yeah. Yeah, you wouldn't want, yeah, but the reason for the short date is you know,
Because
we've
they
seen how the
converge on par. Yeah.
yeah, we've seen how
If you have
yields
a
have
10-year
moved.
treasury that's 90 days from maturity, its value is going to be essentially par. So you know it's worth whatever, you know, the $10,000 par face value.
So we're talking
So
a 1-to-1 ratio, 100% reserve. So this is
100%
not a
reserves.
fractional reserve, you know, system
Right.
here.
Although I've been wondering about that. We can talk about it. So, but just to finish with the Genius Act. So that's the main kind of element that I think is worth knowing about. And then there's kind of some, you know, dicta about how the regulatory bodies are going to enforce all this stuff. I didn't
Yeah.
read the act itself. I've only read summaries, but
I'm sure it's
I think
very,
that,
very long.
yeah, and I think we covered the most important aspects of it there.
There will
So
be
that,
audits, regular audits, I
oh,
think.
right, yeah,
Yeah.
that's worth mentioning. Audits, and then there's a requirement for the stablecoin issuers to post regularly, I don't remember the intervals, but to regularly kind of post statements of what their reserve assets are. You could say reserve assets or collateral. So they want to kind of enshrine trust in the system
Yeah.
by requiring the issuers to say, okay, here's what we're backing the stable coins with. It's audited, it's legit, it's secure. And so ostensibly that's going to create a high level of trust going in. So
Yes.
you don't have to have a couple fly by night stable coin firms go under and have runs and have the dust settle before it, becomes trustworthy. Although I think I'm a big fan of market discipline. I wouldn't mind seeing a couple stable coin, and there have been ones that failed. I was research sources talking about I'm trying to remember the name of the one that went under. Maybe you remember,
While you're
Jonathan.
no, I don't remember that. While you're if you're looking it up while you're doing that, also in the Genius Act, it stipulates that if the issuer ever does go insolvent, that the holders of the stablecoin have super priority over other creditors in retrieving the value of their stable coins.
I was
So
not aware of that actually. I
yeah,
learned something there. That's good.
yeah, and then I think according to the law, I can't remember what part of 2028, but by 2028, if an issuer has not received that certification, then it won't be legal for the exchanges to allow the buying or selling or trading of those stable coins.
Okay.
Yeah. What it just reminds me so much, yeah, I think your comparison to free banking is so on point because I don't mean to get too much into the weeds here, but during the free banking era, there's this misperception out there that there were just no regulations at all. It was just like free for all. And that's not true, actually. There were, and people can debate and have debated the merits and demerits of some of those regulations during the free banking era. But one of them was that an issuing bank for every banknote, they had to have an equivalent amount of state bonds lodged in the treasury of the state in which they were chartered. And then later, after the Civil War, when you had the national banking acts, the national banking system functioned in the same way, only you had to back all of your national banknotes by federal bonds.
And
Uh,
more than 1 to 1 actually as well.
oh, is that true? Yeah.
11 to 10, I believe, or it was 10 to,
Oh,
I think
okay.
it was either 10 to 9 or 11 to 10. I can
To
never
be
remember the
extra
exact
to be
ratio, but
extra
they were
safe.
actually over collateralized. Yeah.
Yeah, that's interesting. And I remember actually Professor Lawrence White, whose class I took at George Mason University, was critical actually of that regulation because he said there were times in which during panics or if there needed to be if the banks actually needed to issue more notes than the restriction allowed, that this was a constraint on the banks that the market would have permitted, but the state regulatory and federal regulatory structure did not permit. But going back to my point, so the free banknotes were backed 1 to 1 or a little more than that during the national banking era. And then if the bank went under, as some did, the holders of those notes were legally entitled to the value of whatever notes they had on hand. They went to the state treasurer and the state treasurer had those state bonds um, in in for that bank, now insolvent bank, on account, and the holder received the value of their note. So there was that built-in protection, and I see a lot of parallels here with the regulatory framework with the Genius Act. By the way, for our viewers, I don't think we spelled this out. Genius is an acronym. It's a little corny, but Guiding and Establishing National Innovation for U.S. Stablecoins Act. So that's what we're talking about with the Genius Act. But yeah. What are any thoughts on that? Do you think this is
Yeah. So when I teach about free banking, in the US, I say, well, it's so-called free banking. There was some problems. Um, I think the collateral, it sounds good in theory because it sounds scary for, I think, people, especially nowadays, because the only currency we've known since probably 1963, I believe, is Federal Reserve notes.
yeah,
And even before that, the only currency we knew was maybe silver certificates for smaller bills, maybe some holdover greenbacks, which were United States notes. You know a lot about this. Um, but even national bank currency, which existed up until the 1930s, it was all uniform with Federal Reserve notes and United States notes and silver certificates. The government really strove to make U.S. currency uniform. There's several different varieties of it. We haven't really known truly private currency since at best 1935, I believe, was when somewhere around there, you might know the details, is when national bank currency kind of came to a close. But we haven't known a kind of independently free private money issuance in the United States since 1861, before the National Banking Acts were passed, and state free banks were still issuing their own currency. So we're a long, long way from true privately issued currencies, even though in the free banking era, which went from 1838 to 1861, let's say, we had these regulations that partially stifled it. I think actually it worked pretty well in certain parts of the country where you had a lot of banks and a lot of competition, development of clearinghouses. The most famous example of that is the Suffolk system in Boston. Maybe we can post there's some neat little articles people can read about that. It was a clearinghouse that forced banks to be kind of, let's say, circumspect about their money issuance, about their banknote issuance, because and this is the regulatory mechanism. The beauty of free banking is that how do you keep banks from overissuing? Well, it's a prospect of the excess notes they issue that people don't want to hold on to or spend or circulate will come back and be redeemed for the underlying money. Of course, in the 1830s, 40s, 50s, the underlying money is gold coins or silver coins. So a bank has to say, well, if we want to issue $10,000 in notes out into the economy, and they do that, by the way, via making a loan. Sometimes they might do it by way of paying people out their deposits when they make a withdrawal. But either way, they're floating out liabilities. And of course, the bank is earning interest by channeling the liabilities it issues into assets such as loans. So we could talk about intermediation if we need to. But people say, well, what's going to keep banks from just making a whole bunch of loans and pumping a lot of money into their local economy and causing localized inflation and destabilizing things and causing people to lose faith in banks and come and run and it collapses? Well, it's a prospect of the bank overissuing is going to see the excess notes come right back to it, and then it's going to drain out all of its gold, which is the core money asset. And if a bank loses its gold reserves, it's done. So there's a market discipline there that's if you have the, let's say, strong enforcement of that redemption obligation, that market discipline by itself should be enough. And this is something, you mentioned Professor White. I learned a lot about this from him and also from George Selgin, one of the great free banking scholars. Market discipline is the rule. Market discipline is the name of the game, and in order to keep that system stable. And as long as it's free for rival banks to enter, and it was, so we check that box for freedom in the free banking era. You're going to have competition between banks, and if the Bank of Barth is issuing too many notes, the Bank of Watts can set up across town and collect all the Bank of Barth notes, and I'll come knocking on your door Monday morning, 8 a.m., and I'll put a briefcase down with $100,000 of Barth notes, and you've only got $20,000 in gold, and you're done. So fearing that, you're going to keep the issuance limited to what will circulate, and you're going to keep one eye on your gold reserves and make sure your reserves are stable, and you're going to do prudent banking. And that's what happened, 95% of the time. There are episodes that's known as wildcat banking. Yeah. Michigan, actually, my home state now, Michigan is infamous for this. Yeah. But it wasn't because we just took away the regulations and greedy bankers ran wild. There are greedy bankers, but people are greedy. But it was just regulatory imprudence, or let's say maybe regulatory, ignorance. The collateral at the beginning of Michigan system could have been private mortgages. So you thought, we can go record a mortgage for however much we want with our local county, and the land doesn't have to have any value. I have a piece of property that's maybe worth $200,000. We kind of live out in a farm, and you could write me a mortgage on it for $1 million. Right. no money actually has to change hands. All we have to do is record it. And then we have an asset of $1 million to collateralize our banknotes, and we can issue $1 million. And if we could, we've only got $200,000 of actual asset backing that. So if we can buy $300,000 of goods, then we've ripped off our customer base to the extent of 100,000. Well, those banks failed very quickly. And the scholarship I've read on it says that probably a lot of those banks that were operated on that kind of fraudulent basis, their bank notes probably, the bank notes collapse in value quickly. They might not have even been issued at par. In other words, a bank that's kind of shaky out in the frontier, not trustworthy, not reliable, you don't know what their assets are, you might not have even accepted their notes 1-to-1 with the actual gold dollar at the time of their issuance. So if you look at statistics on wildcat banks, and wildcat banks are only a few percent of the actual banks that existed. Most of them were sound and reasonable and prudent. But even the wildcat, the statistics on the losses are overstated because they're assuming that those notes were issued at par and that those shady operators were able to rip people off to the full extent of the notes they issued. That's probably not even true.
Right.
So wildcat banking is overblown. Let me wrap it up. Wildcat banking is overblown as a weakness, let's say, of free banking in U.S. history. Now, the big problems for the rest of the system, where it did really well, New York and New England and other states, banks were weak because they could not branch. Therefore, both their assets, their lending, and their liabilities, their deposits were geographically concentrated. So if there was a weakness in your local economy, you couldn't call on a network of banks to support the deposits, or you didn't have a network geographically distributed to diversify the assets. That was a weakness of U.S. banking all the way up until the 1990s, when interstate branching was finally, fully legalized. So that's not a flaw of free banking. Right. That's a flaw of the restrictions against branching, and there's a whole story of the politics and everything behind that. Also, another weakness, and you probably know quite a bit about this, Jonathan, was that banks, especially kind of in the West, which today the Midwest, were encouraged to hold either state bonds, which were maybe kind of shaky because the states borrowed too much. And I believe in certain cases, railroad bonds were also acceptable collateral. So there's a big railroad boom. These bonds were overvalued. They collapsed. That brought down the banking system. Well, is that the fault of the banking system, or is that the fault of the states who created a regulatory framework that basically, I was going to say tempted, but it almost forced banks to gobble up all of these really weak bonds? So I view that as more of a fiscal or political failure than a market failure of a let's say intentionally regulatory hobbled or restrained banking system. So, and of course, I'm the pro free bank. I want more freedom and less government mandates of what kind of security and what kind of assets and what kind of lending the banks do. I think in a more pure system, the banks are going to, by market discipline, forced to be stronger and more prudent. And we see this, it's the same nature of argument that kind of the more libertarian free market type people would make about what happened in the housing, the subprime mortgage collapse in 2007, 2008. Government was kind of forcing banks or incentivizing banks to invest in certain assets and engage in certain practices that they probably wouldn't have done without both the pressure and then the pressure on the kind of lending side, and then the moral hazard on the backstop side. We'll bail you out. You'll be safe. Customers in U.S. free banking era weren't necessarily as scrupulous or cautious about dealing with banks because the liabilities are all secured. So there's a little bit of moral hazard there. Banks can afford to engage in excessive risk because their customers aren't going to be too wary about accepting notes or doing business with any particular bank.
Yeah.
So there's some regular. I covered a lot of ground there. I know, but let's just say there's some regulatory flaws, in my humble opinion. Nonetheless, it worked pretty well. An American economy did pretty well in the 1840s and 50s.
Well, I mean, compare it to the 20th century, and all the how many uh, the Great Depression and all the inflation that we've had since, I mean, you look at the value of the dollar over the last 100 years, and it's just
Yeah,
and
there's essentially zero, and it's interesting too because the free banking episode in U.S. history also occurred during the California gold rush.
right.
So there's actually a pretty significant increase in the supply of what we call base money of gold.
Yeah,
By the time all that gold kind of trickles out, kind of gets back to the East Coast and trickles to the rest of the economy, there's virtually no recognizable inflation.
yeah,
And what about all these banks issuing their own currency? Well, they're only issuing enough to sustain business in their local area, and not more than that, because that reflux mechanism, that market discipline mechanism, is going to prevent it. And it worked. It worked really well. The clearinghouses started to develop, and that regulatory system, you can really see its workings start developing. And unfortunately, that development or evolution of that market process was kind of curtailed by what happens during the Civil War. We go off specie, the government starts issuing pure fiat money for the first time, and then the government's going to impose that regulatory system of forcing its debt into the banking system, and all these strictures on banks that really cause a lot more problems into the Gilded Age. And then that gives rise to the Fed, and then of course we fast forward to today, we're dealing with central bank fiat currency and all the problems
yeah.
associated with that.
And by the way, not to get too far afield, but Jay Cook, who was one of the biggest dealers in federal bonds, was the main architect of the National Banking Acts under Lincoln. So,
Yeah,
that
which
worked out pretty well
forced
for
banks
him.
to buy government
Yeah,
bonds. What a
right.
coincidence, right?
Yeah, not bad, not a bad deal for Mr. Cook. But yeah, I really like a lot of what you said there. You're more libertarian than I am. I lean more conservative. I respect the libertarian position. I
I'd say
just,
I'm libertarian when it comes to banking, maybe
uh,
not social issues.
fair. I don't know. I just think, not everybody is going to be able to like monitor the fiscal health of, this or that or the other. And you could have somebody get scammed, you know. And so I'm a lot more sympathetic to measures like, okay, go ahead and issue your free banking notes or your stable coins. However, we are going to have a regulatory framework backing that up so that people who protecting people who from getting duped, and making sure that in this case with the Genius Act that you have 100% reserve ratio, 1 to 1, and that the assets are actually like meaningful, like that there's stable assets. It's not perfect, treasury, even short dated treasury bonds may fluctuate, but it's that I think that gives it that added security, protects potentially vulnerable clients, and then also just bolsters public confidence in the system. And notwithstanding some of the problems that the collateral system had under the free banking system, I think it functioned in a similar way with the free banking system. It just added to the confidence of the note, and people felt a little more free to accept it because it had that confidence behind it. It does create some moral hazard, perhaps especially with banking, but I think with stable coins, I'm very sympathetic to it. But
Well, let me follow up on that. We're in a world of central bank fiat currency, and that's not going to, that's been the case central banks since 1913, purely fiat money since, kind of depends on how you want to reckon it. We effectively killed domestic gold redemption in 1934, 33, and we lost the gold peg completely in 1971. So yeah, we're in the fiat money central bank universe. So with that being said, I don't see stablecoins as a return to free banking. I just see some elements of free
yeah,
banking that we're layering on top of that system. And I like those elements. I like the added competition, let's say. I like the added competition in money issuance. I like the efficiency.
yeah, for sure.
And with respect to the regulation, I'm okay with it.
Sure.
I think the market is a more robust regulator, although the problem is that you have to have a little bit of pain for people to wise up and demand that kind of regulation, by which I mean, you have to allow some failures. You have to allow some people getting burned. So
Yeah.
then they are on guard against the bigger failures, the systemic failures.
Yeah.
So this brings to mind one of the critiques that I've seen. So the one critique of stablecoins is we're going to have wildcat banking all over again. Well, okay, read the Genius Act, 100% reserves, tons of transparency, audited financial statements. No, but even in my argument is that even in free banking, wildcat banking was a minor little sideshow due to regulatory quirks. So it's just overstating kind of a canard, it's kind of a false argument. So, but putting that aside, some other critics will say like, well, non-banks can do this. Imagine Walmart issuing stablecoins, Amazon. And I'm thinking, Amazon stablecoins, sign me up. Amazon is one of the largest, most well-capitalized, most, let's say, capable companies.
Mm-hmm.
I would trust Amazon stablecoins more than I would my local bank. I'm talking about the small town bank here, because the small town bank is very small. It's not diversified. It has a really small capital base, and Amazon is huge. And Amazon, reputation is so important for them. Amazon is not going to, countenance having the stable coin break the buck, having the par value of its stable coin fall below $1, because that would burn a huge amount of its reputational capital, and that would cause a decline in its stock price and all those other things. So yes, Amazon and Walmart and whoever else, and of course the banks themselves. Yeah, let's have competition in the issuance of payment media, and that's going to bring the costs down and make the system efficient and effective. It's great. I love so my libertarian, free market, free banking side loves that aspect of it. I'm not actually thrilled with the 100% reserves because I think that interferes with financial intermediation. But okay, it's that if this is what we have to have stable coins, I would say it's better than not having them.
So fractional reserve stable coins, potentially.
Well, banks today have no reserve requirement from the Fed, and that's since 2020. And so I've been thinking about how can you intermediate with stable coins? Well, they could be backed by bank deposits, and bank deposits have no reserve requirement. Problem though, there's not a potential by intermediating. I mean, like you can back your money issuance with funds that cost you less than they earn when you issue them in the form of loans. That's what banks do. If stable coins are backed by treasury bonds, let's just say the treasury yield is 4%. Well, the stable coin issuer is going to earn 4% on the assets that are backing the stable coins. And they might have to redeem some stable coins from time to time, but there's going to be a pretty consistent and probably growing demand. That's going to be a good trade for the businesses who can establish reputation and kind of build their network. So the big banks will have an advantage there because they've already got a known brand name. Chase or Wells Fargo or Bank of America stablecoin. PayPal has a stablecoin. I've been using PayPal since 1997 or something, ever since I went on eBay. And I trust them. I've been using them for decades, and they're great. They're very, transparent. They're very efficient. They've got a stablecoin product, and that why not just use PayPal? I've got a bank account. Most of the people I do business with have a bank account. We can use the normal PayPal thing that's tied to the bank account to ACH. But now I could say, well, if I need to do business with somebody who doesn't have a bank account or is overseas or whatever, I can go and just sweep my funds into PayPal stablecoins, and bam, that opens a lot of extra doors and it lowers the cost. So I'm for more freedom, and I think that's going to bring market discipline and efficiency. And yeah, the regulations maybe aren't my cup of tea exactly, but I'm not a purist either. I'm a libertarian, but I'm willing to compromise to get something that's better than what we've already got. I won't hold out for the perfect. We've never had that.
Yeah, you're reasonable.
Even in the gold standard days, we never had perfection because we've always had crazy regulations. Or
there's always been something.
Yeah,
even in the days of like the old coinage, like you had to pay like a fee to take your specie to the mint and get it.
Yeah, we had the problems with bimetallism. We had the Gresham's law.
Oh yeah,
There's always been some kind of
Oh
work.
man,
And,
bimetallism.
I like to say good enough is good enough.
All right.
So,
So
bring the stable coins. I'm a fan.
yeah, the banking system must not be very happy about this.
Well, I don't know because some of the stuff I've been looking at recently, they're kind of arguing that banks. I've seen the argument that banks maybe leaned on Congress to set it up to where with the
Oh.
100% reserves requirement, um, there's not they kind of curtailed the realm of competition, let's say, to the core banking services. So in my article, I said stablecoin issuers are banks, but
Mhm.
they are in a sense they're intermediating assets and issuing a payment medium, but they can't do what banks do. They can't intermediate deposits
Mhm.
and they can't pay interest. That's the thing about the Genius Act. I don't know if we mentioned stablecoin issuers are
Right.
prohibited from paying interest to the stablecoin holders. That's a disappointment. I'll say.
Yeah.
I'm
What
probably
do you think was what was the argument in favor of that? I saw that
well.
too.
I think my suspicion is that that's the banker saying, "Look,
Mm.
we'll we'll accept this, but you're not going to let them pay interest because then they're competing with banks then outside of the bank regulatory environment, which is very, like say costly.
Hmm.
You have to,
Hmm.
know your customer and you have to, have audited statements and comply with a whole raft of regulations from four. I mentioned the four different federal regulators, the comptroller and the Fed and the FDIC and the Consumer Finance Protection Bureau. And the non-bank stablecoin issuers don't have to comply with almost any of that. And if you let them pay interest now and then start intermediating, even if they're only intermediating it into treasury bonds, they will dominate the payment network because if treasury bills pay 4%, well, the stablecoin issuer can now pay me 2% and still earn a nice little spread. The difference
Yeah.
between the two it pays me to hold the stablecoins and the 4 it earns on the underlying assets. And what does my bank pay me on my checking account? I bet you can guess. Zero.
Yeah.
Even the big traditional banks, even on the
Yeah.
savings account, they don't pay me anything. So I don't have any money in there. I put my money in the money market,
Yep.
you know, even though it's like reserve savings.
Yeah, for sure.
Money market is the same kind of thing, It's checkable money markets are same kind of thing. Investing it in treasury bills or commercial paper, very, very short term, kind of safe short term assets.
Hmm.
So I think the 100% reserve thing is probably just to kind of wall off stable coins from becoming true competitors to the commercial banking functions of the banking system. And,
Oh,
no foul because I wouldn't be happy if an upstart could compete with me and not have to deal with all the regulations I have to deal with. If a school set up and said we're going to offer a 4-year degree, but we don't have to get accredited and do any of this other stuff, you and I would say, well, hold on a second, because our universities have to deal with all that regulation. We're going to say,
mhm.
no, we want to impose the same kind of regulatory strictures on you. Otherwise, you're going to eat our lunch. So fair
Yeah.
enough. I'm not too mad at the banks about that.
They're going to look out for their interests, and
Yeah.
that's just public choice.
Yep.
One of the things that I really like about stable coins that we haven't mentioned is I really think this heads off CBDC at the pass, central bank digital currency. I've made a couple videos on central bank digital currency. I've said that from my end, I think the prospect is very dangerous for liberty. I don't like, just on a number of levels, the fact that under CBDC, the Fed or the government working through the Fed could block payments to certain businesses, that the Fed or the government could activate or deactivate your CBDC at will. It can be programmed to prevent you from buying particular items or set like a limit on, oh, you've had too much meat this month or too many fossil fuels. Or you're
Yep.
unvaxxed, so you can't spend your
Mm.
CBDC in public spaces or whatever, like anything like that. So I've been really opposed to CBDC. And what I really like about stable coins is it precludes, or it makes CBDC unnecessary because all of the arguments
It
in
makes it
favor
unviable, I think.
unviable because all the arguments in favor of CBDC, that it facilitates cross-border payments, that it's a represents it's a costless transfer of digital currency, that um, that helps people who are unbanked. All of these things are addressed by stablecoin. So that's one I think, from my opinion, is one of
Right.
the great benefits.
Yeah, I'm glad you brought that up. And I think I agree with your sentiments on that 100%. And we should mention this, that one of the other critiques of stablecoins is that, oh, well, the criminals are going to use them because they're relatively anonymous, or
Yeah.
they're way less traceable than bank account payments. And
Uh,
the non-bank issuers won't be subject to the know your customer and the money laundering and the fraud regulations and all of that. And in my article, I said something like, well, criminals can use cash and
yeah.
have and do. And
So
I
do we
said,
ban cash?
do we ban cash?
Yeah.
Criminals can use cars.
Yeah.
Let's ban muscle cars because
Right.
my wife owns a Dodge Challenger. I think
Oh.
she's responsible with it, but it'll go way faster than the speed limit.
Yeah.
Criminals might use those as getaway cars. We should probably ban muscle cars because criminals can.
Yeah.
I don't think that argument holds water. I think
No.
um, law enforcement will find ways, they'll have to evolve and adapt to, and that's probably good for them to keep them on their toes. But yeah, criminals are going to use it, therefore we shouldn't have it. That's such a anti-liberty, that's just not the American way, I think.
Mhm.
But I was going to say something else on the regarding central bank digital currency.
Mhm.
There was an act that was passed in the House, not in the Senate yet. It's called the Anti-Central Bank Digital Currency something. I don't remember the exact name. And I think it was passed in the House right when the Genius Act came through.
Okay.
And so
Yeah.
that shows in the Republican,
Mhm.
well, actually, the Genius Act was pretty nonpartisan, but I think this is mostly kind of that core Republican
Mhm.
constituency. We don't want CBDCs
No, we don't want it.
for reasons
Trump
you articulated.
Well, Trump actually during his campaign spoke out against CBDC.
Yep.
So
So
yeah,
right now it's the sentiment maybe of the party in power is against it. That could change, of course. But if stable coins become ensconced, well, how are you going to impose a central bank digital currency when people can say, no, no, thanks, I'll just use
yeah,
stable coins instead? So
yeah,
even if they try to launch it, it's probably just going to be a dud, given that there's so many viable alternatives. Now, if we didn't have the stablecoin architecture, the central bank could come out and say, we're launching a digital central bank digital currency. And then they could, through their regulatory power, they could impose it on all the banks. And then you'd be stuck with it unless you want to go back to just pure, straight cash. The existence of stable coins kind of precludes or kind of boxes out
yeah.
central bank digital currency, I think. And that's another benefit. And that's worth the
Good.
compromise of the maybe not idealistic regulations.
Oh heck yeah, it does. Yeah. So you mentioned anonymity. I mean, that's one of the great features of cash and crypto. Are stable coins, you know about that? Are they mostly anonymous, or is it tied to your is there a digital ID tied to?
I don't know enough about it yet.
Okay.
I gave a little talk on this a while ago to a small group, local group of students, and I saw that PayPal has stable coins now, so I went and bought some just so I could say, hey, I have some stable coins. I think it was only
Mhm.
$50. So if I'm using PayPal, PayPal has all my bank. It's tied to my bank, and they know me pretty well. But I think if I'm sending that to somebody like, let's say, overseas with no bank account and no real like digital footprint, I don't know. Okay. These stable coins at some point, and it might be now, are going to be able, through these blockchains, they're going to be able to transfer from one to another. So with my PayPal stable coins, I could pay somebody else and it could get transferred to an entirely different network. And so I think it's going to be less traceable, let's say. I don't know if it's going to
Okay.
be totally anonymous in the way Bitcoin would be. This is
Yeah,
something where I need to really burnish my knowledge on the blockchain and all that, those technical aspects of this.
it'll depend on the issuer and the wallet probably that you're
The
using.
wallet, the
Yeah.
app, yeah. Yeah.
Yeah. This was very good. Dr. Watson and I are both graduated from George Mason University. And you graduated in 2010, is that right?
That's right. Yep.
2010. I was in 2014. I don't think we ever met though.
No, I think we missed each other because you probably
Yeah.
would have come in 2010.
I came in 2009.
Oh, you
Oh,
did?
yeah. Funny story about that actually. So I came in '09 and I was just getting into like libertarianism, like pretty hardcore. This was right on the other side of the financial crisis, or near the beginning of the financial crisis. And I was this is what got me into monetary history, actually. I thought Ron Paul during the presidential campaign, his first campaign had a really compelling explanation. Oh, look at that. Oh.
Big fan of Ron Paul.
Dude, oh man, he's a legend. He's a legend. But it was Ron Paul and his 2007 campaign. I heard him talking about the Fed, the Fed, the Fed. I was like, what the heck is, I had no idea about the Fed other than I was always taught in school. It was progressive piece of legislation and it was just a positive good. And, but beyond that, I had no idea and started like getting into it and reading about it. And that's opened me up to like Mises, Rothbard, and just kind of like dove in head first into a lot of this by 2009. And I was a history major, so or history PhD. You got your PhD in economics, but I had no idea that George Mason University had this big, in the econ department had the Mercatus Center and you had a lot of Austrian um, economists there. I had no idea about any of this. I mean, I'm pretty fresh in this whole world. And I was going around campus. This was like a month after I started attending George Mason. I saw a flyer saying, "Oh, Lou Rockwell's going to be giving a talk on like campus." I'm like, "What? Lou Rockwell?" All right, I'll check this out. That's strange. Like of all people, like so I like went and there were like probably like 100 people there. And I was like, what is going on? And like one of the professors like introduced him. I can't remember which one it was. And I went to like one of the students. I'm like, are there a lot of libertarians here at Bison? And he looked at me like,
That's
are
funny
you?
that you didn't know that going in. Yeah.
He looked at me like, how do you not know this? And so anyway, I was like, what? That's wild. And so I ended up taking, because I was studying monetary history, even though my PhD was in history, I had the privilege of taking a course on Austrian theory. I took that with Professor Chris Coyne. I took theory of monetary institutions with Dr. Lawrence White, who's like the foremost like expert on free banking and
Yeah,
monetary
Lawrence White
theory.
is one of the top, probably actually the top person in free banking
Yeah.
scholarship today.
Yeah.
Well, George Selgin, of course, one of his top students is right there with him.
And then I never took a class with Dr. Pete Becky, but he had a
Pete,
PPE.
Pete was my advisor.
Oh, sweet. Yeah.
Yeah. I went into Mason. So I would have, in my final year, I was just finishing my dissertation. And so I went and got a visiting teaching job. So we would have not been there at the same time, but we just missed each other. But I went into Mason kind of knowing like this is a hotbed of free market. If you want to say libertarian and Austrian, it's not just Austrian though. It's like the Chicago school and the Austrians, and it's a nice little eclectic mix, and you get some different perspectives, and it's great. I had Walter Williams for micro degree, and he kind of teaches the UCLA, the Armin Alchin UCLA, which I love. So I'm an Austrian, but I've got Ludwig von Mises here. One of one, it was a custom portrait from my brother Joel, who's an artist, and,
Oh,
and so we were in business together building houses too. He's an entrepreneur too. But yeah, so I knew that going in. I had been familiar with um, a lot of the Austrian scholars back in my undergrad days, even before, and Walter Williams. I've been reading his columns in the newspaper since I was a kid. So Mason for me was just like it was heaven. It was great,
yeah.
and it's a really good experience. I'm so glad I lucked into it because my brother and I kind of had to shut our business down building houses. It was actually late in '06. The housing market was starting to kind of tighten and crumble even then. It was like, we have to get out. There's no way we can sustain this. Then, of course, the big subprime kind of collapse hit the next year. And then the big financial crisis hit the following year. I was in grad school at a very interesting time when that financial crisis was the biggest one since 1930s probably. And it was a really good time to be studying monetary and macroeconomics. Um, I tell my students and my family and friends that I've got the best job in the world. Teaching economics is something I'm interested in anyway. It pays really well. and it's pretty darn easy, especially compared to my past career of construction and, doing real work like pouring concrete and building. And it's a
Oh,
dirty, sweaty, difficult job. And now I have what I call a luxury job that pays
oh
even
yeah.
better than I ever imagined. So it's a real blessing to be doing this. And it's an honor to be talking about free banking and stable coins with you, Jonathan.
Yeah, it was great. So, all right. Hey, thanks for agreeing to talk about this, and hope this was enjoyable for
Oh,
our audience.
absolutely. Yeah, absolutely.
Yeah,
Hope to talk to you again. Maybe we can delve into some other aspects of monetary history.
sounds good. All right. Thank you.
Yeah,
And
you
so
bet.
long, everybody. Bye.